Hi, everyone. Thank you for joining. I'm excited to kick off this afternoon's panel, building on prior discussions on first-of-a-kind financing at the Climate Keynote. In this discussion, we'll be focusing on strategies for financing first-of-a-kind projects that are accelerating the transition to sustainable energy. We're going to be digging in to both the challenges and opportunities in project development and financing with Fervo Energy, who has quickly become a leader in the deployment of next-generation geothermal technologies. Since its founding in 2017, Fervo has raised close to $1 billion from a diverse set of investors and has contracted over 650 megawatts from utilities and companies in need of clean, reliable power. We're also going to be hearing from Breakthrough Energy Catalyst, who is taking an innovative approach to financing commercial scale projects utilizing emerging climate technologies. We're going to aim for about a 40-minute discussion and then leave time at the end, about 20 minutes. So if there are burning questions that come up during our session, please write them down. Before we jump in, let's start off with a round of introductions. I'm Elle Brunsdale. I actually started my career in clean energy finance here at Yale. So very excited to be back. Since then, I've been working to deploy utility scale and distributed solar, wind, and storage technology at D.E. Shaw Renewable Investments, and most recently at Greenbacker Capital, where I also led a first-of-a-kind investment into electric vehicle infrastructure. In my career, I have found that creative approaches to financing have huge potential to unlock value and get projects built. So really excited to be here today. And with that, I'll let our panelists introduce themselves. David, do you want to go?
Hi, everyone. Thanks so much for having us. Really excited for the conversation today. I'm David Ulrey. I'm the CFO at Fervo. I've been at Fervo for about 4 years now, so came into the company just after the company had raised its Series B round of financing. We've since raised a Series C, Series D, and a little bit of debt along the way. So really excited to talk to you all. My background, I spent a little bit of time in the Army after undergrad. Did my business school with chalkboards instead of dry erase boards, which is antiquated technology. But then spent some time in the oil field doing investment banking and then doing M&A and investor relations for a public oil field equipment company.
Hey, everybody, and Elle, thank you for having me here today. So James Blake, I am a director on the Catalyst team at Breakthrough Energy. Little background on myself. I've spent my career investing and financing energy infrastructure projects. And so I joined Breakthrough about 2 years ago. I left my job at a private equity fund focused on energy called LS Power. And I came over with 2 other ex-colleagues to launch what we call the Catalyst program within the Breakthrough family. Breakthrough, as kind of level setting here, if you're not familiar, this is the platform that was founded by Bill Gates to fund and invest in emerging climate technologies. The way I like to describe us is we were really set up to track the full life cycle of technology development. And so we have folks in what we call our Fellows program that does early stage kind of startup funding through partnerships with universities. Then we've got our ventures arm that does typical company building, growth equity. So think, Series A through Series C. And then you come to where I sit, which is called Catalyst, which is really the infrastructure arm of Breakthrough. And so what we're focused on is deploying into projects, so real assets that utilize these new technologies.
That's great. Well, thank you both. So to get things started, we thought it would be helpful to have kind of a visual an image of what Fervo is building. And so thank you. If you wouldn't mind putting up that image. I think, David, it'd be helpful to just help provide some context to the audience on why has geothermal not been more widespread? What have been some of the historical challenges in the space? And how is what Fervo's doing different?
Yeah, I'm happy to. This is always the point where you look at the slide as a former investment banker and you're looking for your own misspellings, but I don't see any yet, so we're in good shape. So we've got a picture up on the screen here of traditional hydrothermal geothermal on the left, and then what Fervo's doing, which we call enhanced geothermal systems, on the right. From a fundamental perspective, geothermal assets, kind of regardless of their source of resource and brine, provide a clean, firm power backbone to the grid that you can consider complementary to wind and solar and batteries and that sort of thing. So really, really attractive. And particularly as we think about AI and data centers, one of the hardest pieces to solve in that equation is how do you get clean, firm power? There just aren't many ways to do it. And there's just not much scale being added to the grid. And so it does beg the question, why hasn't this been done before in geothermal broadly? On the left, we kind of have these limitations of geothermal, and they really all come back to one thing, which is conventionally, geothermal has really looked for naturally occurring resource in the subsurface. So if you think about really interesting geologic hotspots, you typically think about Yellowstone, you think about the geysers, which is the largest geothermal asset in the world. You're looking for places where that geothermal resource is really, really close to the surface, and it's really well understood, but you're a taker of that resource. You're a taker of the natural permeability that's in the subsurface. That's how you produce geothermal brine, is you produce literally the geothermal brine that's already existing in a fault structure or an otherwise void space in the ground, and you exploit that or you produce that by drilling a vertical well into that resource, and then you suck it out just like you would out of a straw. Those resources can be really, really good. And the geysers is the best example of that globally. You know, today the geysers is around a 700 or 800 megawatt asset, so a very large power system. Most geothermal assets in a conventional sense are closer to 50 to 100 megawatts. The challenge with conventional geothermal assets is it's actually quite difficult to understand what you're looking at in the subsurface until you drill a well. So that leads to really high exploration costs to understand, is what you thought, what was a void space, is it actually a void space? Has it been calcified? If it is flowing, what temperature is it flowing, and what's the volumetric flow rate? And then where does that fault structure extend to understand how far and how much production you're going to have over the life of the asset? These are power plants, and so they really do rely on a project finance approach to capitalization, which means that you have to have really stable production over the life of the asset. And that's specifically where conventional geothermal assets have struggled in the past. And when I talk to investors, usually the first question I ask is, how much do you know about conventional geothermal? Have you invested in one? If the answer is yes, I have, then I know I'm starting from behind the eight ball because they probably lost a whole bunch of money. And quick fact is, I've run into quite a few of these people as we're pitching Fervo. To date, 0 people that have invested in conventional geothermal have invested in Fervo. It's that much of a barrier to this because the industry as a whole suffered so greatly from this lack of predictability in the resource. If we fast forward to Fervo and look at the right side of the page, really the only difference that we're inserting into this equation is how do you access the resource in a way that's more predictable, more reliable, and more scalable? So how do we move from a system that is really a naturally occurring phenomena, of which there just aren't very many known resources, and move into something where it is really widespread? And this is where we insert what we have borrowed from shale oil and gas, which is horizontal drilling and multi-stage stimulation. And so our base system is drilling 2 horizontal wells that are somewhere between 300 and 700 feet apart. We put those horizontal portions parallel to one another like you see in this picture, and then we fracture the rock between them. And those fractures are what create the access to the reservoir. But where in conventional geothermal you were a taker of whatever was there, we now have the ability to engineer how much exposure we have to the resource. So we can drill the laterals, the horizontals of our wells longer or shorter. We can increase or decrease the spacing between those wells. We can change the design of the stimulation treatment. And so all of a sudden we have levers to control and engineer the production rates and the life cycle of these wells in a way that conventional geothermal never did. And you add on top of that there's not much naturally occurring resource in the US from a hydrothermal perspective. There's actually an enormous amount of EGS resource in the US. And you think about what's going on here. I'm a dumb finance person, so geologists always get frustrated with this comment, but the Earth almost always gets hotter as you go deeper. And so from an EGS perspective, if you're not accessing the resource temperature that you want, you drill a little deeper. It is truly as simple as that. There are certain regions where the resource that you want is more shallow than others. And when we talk about that, we talk about Nevada and Utah, which is where Fervo is drilling and building a project today. But you can fast forward to a world 10, 15 years in the future where we bring drilling costs down, and maybe we're drilling twice as deep as we are today, but we're doing that on the East Coast or in places like Colorado and different areas in the Midwest. And so those are the fundamental differences of what we're trying to do. But when we package all this together, if we can make geothermal a more predictable and reliable resource, then we can project finance these in a way that conventional geothermal couldn't. And if we can increase the amount of resource that's across the country, we can scale this to be a resource that can actually meet the power demands of today.
Well, thank you, David. That was super helpful. Also, just very clear breakdown of where the innovation is, and helpful to understand too. Just that point you made about no investors in conventional geothermal being investors in Fervo. That's really speaks to the challenges in the space and being an innovator in a industry that's been facing a lot of challenges in the past. Would love to now turn to the financing strategy. Can you take us on a journey of from initial pilot stage to today of how you've approached financing? What kind of investors have you gone out to? What kind of capital have you brought in at various stages of development?
It's a really good question, and I'll say that there are several inflection points in the story, including an inflection point at where we are today. But the story always begins with a hypothesis. Our co-founders, our CTO and our CEO, Tim and Jack, when they started out, they had a hypothesis that they could apply shale oil and gas drilling techniques to geothermal and do something in geothermal which was very similar to what happened in shale oil and gas. And sometimes we call this the third molecule. Horizontal drilling started in natural gas formations with fracturing. And people said, hey, great, that's great, it'll work in natural gas, it will never work in oil. Obviously, now we know that shale oil is an enormous part of the American productivity mix. And they said, great, that's great for natural gas, it's great for oil, it's a shame it will never work for anything else like this other molecule, water. And that's where Tim and Jack saw an enormous opportunity to apply these lessons learned. And so it starts with that hypothesis. They go to the venture capital community, and this is, you have to find the venture capital that is specifically looking to take on technology risk. So is there a really big market opportunity that justifies investing in these technologies that are looking to test a technology approach and validate a technology approach? Ultimately, Tim and Jack found Breakthrough Energy Ventures as well as a couple other 3x5 ventures. And they used that capital to, one, go find resource, and then two, start testing their hypothesis. The first hypothesis was we can fracture a geothermal formation and establish conductivity in a way that's never been done before. And so they started small. They went into an existing wellbore and they just tested that one question alone. Can we fracture a geothermal formation and get what we need? The answer was yes. So you fast forward to a Series B. Now can we add on a layer? Can we actually drill the well instead of going into an existing well? Still, this is venture capital, but it's a little bit less risky venture capital, and that's a gradient. But you start to recognize there are people that want seed stage and Series A, and then there are some that want Series B and C. And that's a oversimplification of how they think about it, but many they'll start the conversation by saying, we want Series B or C or whatever it is. For us, that was Capricorn. Capricorn led our Series B, and what we were trying to do with that capital and what we did was we drilled wells in a geothermal formation. After we had drilled the wells, we fractured the wells. And so now this validated, one, that we could fracture the formation that we wanted, two, that we could actually drill the wells that we needed, and then subsequently fracture them, which we already understood. And that gets us to the point where you start talking about, well, how do we scale it? How do we get something that's a little bit more? What's interesting in that is that even though, I'd say almost universally at this point, companies believe we have de-risked the technology, and that's certainly what Fervo believed. You almost have to take a step back and have an honest conversation with yourself in the mirror and say, look, we're a little bit biased towards our own success. Yes, we have demonstrated that this technology approach works, but is it truly de-risked? And we can talk a little bit more about that. But the goal in doing that is to get to the later stage venture capital and start to drop your cost of capital a little bit, because now as a hard tech business, you have to deploy tremendous amounts of capital, and you don't want to suffer that dilution at your top go. So we raise a Series C on that premise. We think that we have de-risked the technology. Maybe we can't prove it to you yet. We haven't scaled yet, but we're going to raise this capital, and we're going to start deploying that capital in a way that will prove that we can. So that Series C investor was taking the question, can they, we've demonstrated technology, but can we actually take that demonstration and carry it forward to something that's more grand? And so we raised that Series C. DCVC led that round, and we started building our first project in Southwest Utah, which was our own site, our own acreage. We started drilling a few wells at first, and you used the success of those first few wells to say, look, we did this over here in Nevada. That was our commercial pilot. We demonstrated the technology. We built a commercial pilot. We raised a little bit of money. We replicated that success over here. Now, all of a sudden, we have production results from the commercial pilot, and we've shown that we can do this again in another site. You take that success and you try to raise a little bit less expensive capital in a Series D. That Series D for us was led by an oil and gas company called Devon Energy, who knew a lot about drilling wells. And so they were able to take an opinion on long-term forecasting from a production standpoint. And then when we raise that Series D, that becomes your scaling capital. And so that's where we said, look, we need to raise, in this case, $244 million to go build out a 100 megawatt power plant. That was in February of 2024. We did an extension to that Series D that said, look, things are going really, really well. Let's raise a little bit more to continue to round out that capital stack for that first 100 megawatt project. And that leads us to today.
Wow. Great. Very helpful. And also interesting just to hear the incremental steps and even and honestly great strategy of starting from what you know, from starting from an existing well and innovating from there. And so, turning to you, James, where would you place Catalyst strategy on that spectrum of risk? Are you taking technology risk? Are you at what point would you be coming into a project like Fervo's?
So, and I think you kind of hear a little bit of this in the life cycle that David went through is right now, and by the way, this is a problem a lot of people have talked about, including today, but venture capital has been fantastic in partnering with companies like Fervo. Breakthrough Energy Ventures, one of our affiliates, had invested in them early on. They've been great getting through what we would call the proof of concept stage, right? So they're able to fund that early stage R&D money. They're able to get that demonstration facility out into the field where, from the company's perspective, you've actually de-risked a substantial part of your technology. On the other hand, when you start talking about building infrastructure, right? So putting that technology into the $500 million or $1 billion project, you now need to go to a very different source of capital, right? You're going to what we would refer to as like the project finance markets, which is your commercial banks, which is your infrastructure geared or energy geared private equity funds, and you're going to them to look for significant amounts of money. And what they want in return for that is that they need a de-risked asset. They're doing these at returns that are well inside of venture capital, right? A solar, for example, that might be a 6 to 8% return. And so you're looking for very stable contracted cash flow, something that's de-risked, but you have that kind of infrastructure-like protection on it. The problem is with these early projects, you haven't gotten to that inflection of completely commercially proven, right? And when I say commercially proven, the benchmark a lot of people look for is, has a engineering firm come out and can issue you an opinion saying, hey, this is a commercially used technology. And unless you have 2 years of operational data, no matter what you've done before that, it's almost impossible to get somebody comfortable. And so that's kind of the premise of where the capital stack is. And really what Catalyst was set up to do was to help kind of bridge the gap between that, right? What is the kind of handover between our venture capital kind of R&D arm and what is needed for scaling these businesses and these types of projects, which is conventional project finance. With that being said, the way that we've tackled it is we've really tried to set ourselves up as an infrastructure strategy. And so myself included, we've hired people from the project finance banks. We've brought in people from developers. We hired a head of construction who spent 20 years at a large EPC firm, really to try to gather the people who could go from, okay, this is about proving technology to this is evaluating infrastructure risk. And so when I think about how we approach this, there's the capital component of it, which is going through kind of our processes and checking the boxes on, does this make sense from a project finance perspective? But it's also leveraging a little bit of our niche kind of insights where we have this background that a lot of people in the climate space don't necessarily have because it's not because infrastructure has never been the kind of the root of funding for these companies. And so when we work with companies like Fervo, part of what we try to do is kind of lend our industry experts to help them think through, okay, even if we're a bit different and we can take more risk than a typical project finance lender, how do we make sure they start thinking about what a true project finance lender is going to need when the time comes that they need to raise that type of capital?
Great. It'd be great to dig into one of the points you brought up around it's really like de-risking the lack of data and uncertainty. And you mentioned independent engineering reports. David, would love to hear how you've approached that. I know from our past conversation that you were pretty early in seeing the need to have those stamps of approvals going into conversations with investors.
Yeah, it's interesting. I'm not an engineer. I mentioned I work with a lot of world-class engineers, and sometimes I think the challenge of being a world-class engineer, particularly one that's thinking about something that's never been done, like enhanced geothermal systems, is that if that's your job and if you founded a company on it, you are the world's expert in that technology, and there's probably not anyone else that's going to come in and kind of a 2 to 3 month period, get up to speed, understand it, and be able to provide a better technology lens on that problem than you. But like we talked about before, CTOs and co-founders are not unbiased. And so you need an unbiased party to come in. And this is something that we looked at between our series C and D was how do we get some form of external validation? And so the notion in project finance is, well, you go throw an IE report on it. You grab yourself a logo, you slap it on the cover. The challenge with doing that on something that's never been done is that the IEs have never done it or understood it or looked at it. And so you have to back up even further and say, how do we educate the independent engineering firms and get them up to speed on something that we're doing, give them enough time to marinate on it before your investors are coming and asking them to sign on to a scope. Because if they sign up to a scope that they haven't been educated on, you as the company may not be happy with how they present the information in the independent engineering reports. And there have been several occasions, actually, in Fervo's history where deals didn't get done or investors backed out. And we always try to do a postmortem, and you ask, well, why not? And you start digging into the IE report that they commissioned and paid for, and you find just what I would call an absolute fallacy in the data. Something that's just factually incorrect, and it's the company's fault. It was our fault that happened because we didn't train them. And so for us, we built this commercial pilot in Nevada. We brought it online, and before we brought it online, we went to an IE, independent engineer called Jacobs, and we said, hey, Jacobs, can you come tag along? We think this could be interesting. We'd like you to look at this. We let them observe our techniques in construction. We let them observe our testing. And then when it came online, they were well equipped to put an IE report in place and say, yeah, we've watched what Fervo did. We understand the technology. We're comfortable with it. This is a technology readiness level 9 project. And so we got some external validation on that. This was actually really important as we start talking about the Series D and putting capital at the project, because we've now proven and we have someone that says, yeah, the technology works. But how do you forecast what that production is going to be into the future? And that forecasting is even more complicated than answering the question about just does it work? And that's something that we've tried to fast forward with Jacobs. And now Jacobs was our first. We've tried to expand our scope and our net of independent engineering firms that understand this, because each time someone wants to invest, they are going to want to hire an IE to do some form of report, and you want to have a bench of IEs that at least know and understand the technology so that you as the company can help control some of the outcome there.
Great lesson there, just on the importance of involving partners like IEs early on, not waiting for the diligence questions to come up and for investors to drive that process necessarily. But James, could you walk us through how you approach diligence and I know a lot of the big value you all provide is in helping these early stage companies prepare for more robust diligence processes down the line. So it would be great to hear a little bit more about that.
Certainly. So I think when it comes to diligence, and maybe I'll frame this in what are the risks that we're very focused on for these like early commercial projects, right? And the buckets I probably put this in is, David Ray talked about one, which is technology performance, right? And, I kind of want to go through what are some of the things you can do to put that in a box that is underwritable for investors. Then there's I'd say similar, but kind of often, seen as a secondary, but just as important in my mind, which is construction of that asset, right? It's not just hey, is the molecule going to produce like it's forecasted to produce? it is, okay, have I designed the balance of plant around my system the right way in which we're not going to end up in a spot where construction has gone 2-3 times over budget, right? And so I'd put that in its own category. And then the third, which I'm sure we'll talk about a bit, is kind of the commercial wrapper around that project, right? And when I talk about commercial, when we're in kind of the project world, I'm talking about what has been set up to de-risk the cash flow stream for that asset, right? What's in place for offtake, right? Your revenue contracts. What have you done around feedstock, around your equipment supply contracts? Who are you procuring from? That type of stuff I'd put as the, kind of the commercial bucket. Stepping through each of those, on the technology side, I think one of the things that we give Fervo a lot of credit for that other companies who have been successful have done is they've kind of scaled up in steps, right? And what I mean is they first went out and they did a pilot facility, right, where you're kind of gathering data on the technology itself. Then you're going to what I would call a demonstration. This is, we talk about first of a kind. That's what I would really call the first instance, which is this is a smaller plant that's probably not economic, but you can do it on balance sheet, and you're actually building, a small scale of your unit, but you're putting the full integrated system around it, right? So you're putting the balance of plant, whatever your output is, you're selling it to somebody. You're actually showing how the end-to-end process works. And if you do those two things, you can really get to a spot where technology performance is no longer binary, right? And you can go to those engineering firms and you can have them come out and do that. And you can get some comfort, right, for the investors that there is a band of outcomes, right? It's not going to be the perfect, hey, this is commercially proven. But for me, if I'm able to, the way I'm underwriting this is, okay, I know availability is going to be, 80 to 100%, right? I've at least got a band that I can underwrite to. So that's technology. On construction, I think one of the things you see by going through that same sequencing is how do I build my organization out around building that asset, right? We focus a lot on the project. And I think, David, we were talking about this before, right? You probably start with maybe 15 people, and all of a sudden you're building these projects and you're growing your company. And sometimes there's a tendency to focus on kind of what which is the R&D, the engineering. But when you get into this real asset world, there's a whole nother skill set and kind of group of people that you need to ensure you're executing, right? When you think of project development, the permitting process leading up to when you break ground might take 2 years. All in, door to door, construction might be 4 to 5 years. And so if you're not bringing those people on early to really kind of fine tune your permitting plan, your design plan, your actual, what I would call like development, you can end up in a spot where things that seem small at the time in the grand scheme of kind of your company is scaling are missed. And that's when we always uncover during diligence, hey, you focused a ton on the technology, but your balance of plant, we think it's going to cost 2 times as much to build, right? Because this hasn't been designed properly. So I put that there. And then when it comes to the commercial side, the lens I like to look at it through, or the way we approach it from a diligence perspective, is we take the most conservative view, which is, what a commercial bank, a project finance bank would do and say, hey, there's 30 items on my kind of scorecard here, offtake, feedstock, binding equipment supply agreements, right, site control, all those like good things. And I say, okay, if we're taking a big risk on technology and scale up, the other 33 out of the 35 need to be checked. And, again, credit to David and his team. One of the things they did is they did check all those other project finance boxes. They got the offtake, they've got the EPC strategy. You could talk about it more, but I think that aspect really lets us, again, we're a bit different than a traditional investor, but if I can kind of underwrite those bounds on technology performance, if I can get comfortable with the construction plan and the track record there, and I could say, okay, we've got 95% covered on this, well, that's the risk that we were set up to take and to do to try to get these companies to that next stage.
That's great. Also, David, I'm curious, as you're hearing James describe this approach, to take a step back, there's often people talk about a mismatch between venture and growth investors and traditional infra, even like a missing middle. How similar or different does the approach that James is describing? How similar or different is that from other investors that you've been partnering with, and is it ever challenging to bridge that gap between the more early stage investors and infrastructure oriented investors?
Yeah, it's a really good question, and I'd say that what Breakthrough has done is actually unique. It's just very difficult to mix these concepts, and you even think about, if you just think about venture capital leading into some form of growth equity, moving into infrastructure and kind of cost of capital coming down across the spectrum. You look at kind of the growth equity bit that you say, oh, what are you talking about missing middle? There's like some right there in the middle. It's called growth equity. But that growth equity won't take that technology risk that James was talking about. They just won't. And that's because you're going to ask them to deploy billions of dollars into these assets. And so that's not really an option there. It's funny, James mentioned that the 33, 35 things, have to be checked. That's exactly how we think about it. And, part of our job is to talk to lots of different investors and to go knock on doors and ask for capital that we're not ready for. They tell us that. We ask them why. You collect feedback along the way, and you have to do that. And that's exactly how we kind of uncovered, look, when we show up to someone's doorstep, the only thing that we can't control is technology. We can't speed up time and show you 10 years of results. But everything else has to be covered down, and that's something that we can control. And so that's the exact strategy that we took to start closing this gap. And it works sometimes, and sometimes it doesn't, just to be perfectly candid. That one technology risk is something that is ill-defined, and it's something that's omnipresent. Your job is to put as much factual information around that, as much data around that, to try to turn the tide there. But it's really difficult. When working at a startup is interesting. You have this notion in your head that if only we could achieve that, then like everything else would be easy from there. And so I'll never forget, we brought our commercial pilot Project Red online, and we were like, we did it. Where's our money? And everyone's like, yeah, that's cool, but like you don't have any operating results. Like come back when you've got kind of like a year of operating results. And so we go away, we get 12 months of operating history, and we come back and we say like, cool, we did it. Where's our money? And everyone's like, yeah, but like it's not 10 years of operating history, And so like it's this moving goalpost. And I think one thing that we realized is that goalpost will always be moving. There's always going to be a risk on a project that's difficult to get around. The only thing you can try to do is mitigate it. And so we look at different ways of mitigation, and that's part of our pitch to people is let's take this technology risk. Let's break it into bite-sized pieces. Is it a true binary risk, or is it a CapEx risk? Is it an OpEx risk? How do we solve for it if the worst comes true? And that's been a big part of trying to bridge that middle. But it sometimes it works and sometimes it doesn't. But I'd say that's where firms like Breakthrough and Catalyst are very helpful, because there is a huge gap in the middle.
Yeah, I guess the key is finding the right partner. James, I'm curious, you talked about your diligence process, but could you share a little bit more on an ongoing basis how involved you are with your portfolio companies, and what does that relationship look like? And then after that, David, I'm going to ask you as well in terms of how involved are investors in Fervo's strategy?
So in terms of maybe I'll even start with kind of like what is our typical kind of structure or story look like on this, right? Where we play, a lot of times the companies we're working with are what I would put into like late stage development, right? So these are companies that they've kind of got, from our view, good fundamentals on the project, meaning they've got a site, or they've got an option on a site. They've kind of done that initial engineering work to really map out and understand their costs. They've got some commercial discussions going on, and they've obviously checked all of these, I'll call them technology de-risking milestones that we talked about, right? They've gone through that life cycle. So we look at a company like that and we say to them, we'll give you, an investment from us, but we really need this to be project finance ready. What does that mean? It means typically what we'll do is we'll put out an equity commitment, a binding agreement to invest in that project, and we'll leave them a roadmap of 15 items, right? We'll say, hey, come to us when you've got, your CO2 supply secured, right? And we do this, and it does two things. One, I think what's different from us and other kind of infra-style investors is if you talk to anybody else, they would just say to that company, hey, come back to us when you're ready, and then we'll go through diligence and do that. Because we're set up to really lean in on this, one of the things we try to do is we do all of our diligence, we go through all of the documentation, we give them an investment and this binding commitment, which it helps because now they've not only got a roadmap, but when they're going out and going to corporate investors or the banks, they can say, hey, I've actually got 75 or 100 million that's lined up as long as I get these other things. And so that starts our partnerships with companies pretty early, right? I have an example of a fuels company that I had done the investment when I first started 2 years ago, a couple months in, and we just broke ground on construction and took FID 3 weeks ago, right? And so it was really like an 18-month process from, hey, this is a good project and a good idea, to let's actually start spending money and putting steel in the ground. That being said, we don't just sit idly by during that time. I think one of the pieces of Catalyst that is interesting is, we're set up to also be educational in a sense and helpful from a expertise perspective. And so I talked about the build out of our team and a lot of our backgrounds from the project finance world. Once we've partnered with a company, we try to be an active participant. We've got the Breakthrough Network, which is helpful in, if there is, if Fervo's got electrons that are still open for sale, we'll tap into the network and find people to partner them with. I think having us as a backer and a certainty of commitment for that project is helpful. A lot of times, if you talk to people looking to get offtake for a project, no one really knows if something's real or not, right, when it's in that development stage. And so I think even just by giving that capital certainty, it actually helps bring a lot of validation that, hey, this project might take some time, but it's going to happen at some point.
David, is there anything you want to add there? And then also something we haven't talked about, which James just brought up, is just offtake strategy. And I know you all have done a lot of work building great relationships on the offtake side. So yeah, wherever you want to take it.
Yeah, I think that, are your investors, are they capital or are they value add or are they both? Is always the question. I've never showed up to a pitch where the investor didn't explain to me like how they add value to us. I'll say that not all of those have come true, but I think in the instances where it has, with Breakthrough in particular, they invested in our Series A very early in our life cycle, as well as Breakthroughs, to be honest. And the board member, the partner that led that deal, Dave Danielson, he is a technology guru. Like when it comes to like, how do you take this idea and turn it into technology and then take it from there and kind of pass the baton, that is his specialty. And he was very good at it and very helpful along the way. It's interesting what Breakthrough's done with Catalyst as in that education component that James mentioned is really important. And I think that there's probably an underappreciation for how hard it is to build a project, a seemingly simple idea, put steel on the ground. The challenge is in the weeds, and it's all this stuff that you've never heard of or considered. But I'll tell you, like our organizational structure, our entity chart is like one of the more complicated and nuanced questions I've ever thought through. And I remember a couple weeks ago, I called James, and I was dealing with like an accounting question, like how are we going to consolidate our balance sheets because we have these assets in different entities that all lead up to like one big project. And I was like, how are investors going to think about this? When we show up to lenders, what are they going to expect to see when they say, give me your project financials? Because to truly deliver project financials, I have to send you somewhere between 3 and 5 balance sheets, and it's like a question that I don't have the answer to, but James in his experience does. And he has, his own experience to rely on, as well as the relationships with other commercial banks and everyone else. And I think, having a partner that's there, that you're not worried about scaring off, is very important. Because I think that's like something whenever you talk to investors, you have to remember they're always evaluating you. And so like that's something that you have in the back of your mind, and you don't want to ask the wrong question lest they lose faith in your ability to build a $600 million project. And so that's something that we've turned to time and again as we've kind of grown in the Breakthrough portfolio, is just here's insert weird question. I just need some honest advice. You can go to investment bankers. They're always trying to sell you something. I was one, like he was one. It's just how it is. And so it's helpful to just have an honest opinion there on the other side of things.
Well, I know we're getting close to question time. Maybe I'll just ask one more question, kind of taking a step back, looking ahead. Like what's needed to scale, in terms of bringing in more traditional project finance capital, the MUFGs of the world. David, I'll ask you, and then James, same question for you in terms of bringing in, Ellis Power into the space. Like, what's left? What are you focused on to really achieving wide scale adoption?
I think for us to truly scale, it is almost purely a capital question at this point. And I think what we always encourage investors to do when we're working with them is let's define what your concerns are and let's talk about how we mitigate those and let's really understand what the risk is. I think what's frustrating from our perspective as a company are investors that label it as risk and can't define it further. There's just some sort of nebulous risk that has them concerned. And so I think for us, accessing capital is reliant upon defining that risk and really boiling it down to what it means for the project. And the more we can do that, the more access more capital we can access, and the more we'll scale.
So on this one, I think what's interesting is when we think about kind of capital availability for these technologies, I actually think there's the capital there, right? That's very interested, once the technology has hit a certain milestone, right? Like I talk to my colleagues at project finance banks about every project that we invest in, and the answer is always, sounds super interesting, bring us the next one. We'll really like to do that. And, there's no shortage of that and that amount of capital. I think, on the earlier side, there's plenty of funds that have been set up to do this kind of early stage VC, right? We always come back to, we call it the missing middle, the valley, whatever you call it. But to me, for scale, it's really how can we more quickly partner companies with that right capital to get them to that project finance, right? And I think right now it either exists and is not kind of actively participating. You said, how do we get the Ellis Powers to do like this type of project? My gut is that we're not gonna get them and that capital to do it. I also don't think we're going to get venture capital to do it. And so the question to me that I wish I had an answer to is, is there somewhere in between, call it growth, call it, private equity, right? That has LPs that are more flexible on their allocations, right? They're not just, hey, this needs to be core infra, or this needs to be VC, or this needs to be PE. You almost need somebody who can take a more holistic approach to, okay, maybe I'm doing some equity, I'm doing some debt, I'm doing some development capital, I'm also doing some project financing, and you're bringing a package that gives you the adequate downside protections when you're doing these early stage projects, but also you have tools to capture the value, in my mind, the immense value that's created once you get over this first milestone. So I think that's what we need.
Great. Well, thank you very much. I think with that, let's turn it over to the audience. Are there any questions? Yes, over here.
Great progress on Fervo. Tim and the team should be really saluted for it. My question is, looking forward, when you go from where you are today to a project financing, maybe that's project number 5, 6, 7, I don't know. What elements of your business model would shift as you go from this state to the new state? Whether it's your off-takes, whether it's your partners, whether it's licensing. I mean, just talk us about where you're going if this goes on to project number 7 or 10.
Absolutely, and that's certainly the plan. Sorry, do we have the picture by any chance?
Is it on maybe the next slide?
Oh yeah, there we go.
There we go. Yeah.
Sorry, I just realized it wasn't up there, and it's super cool to look at. So I thought I'd throw it up.
It's a great one.
So this is our first project. This is a 100 megawatt project in Southwest Utah, outside of a little town called Milford. It's exactly 3 hours south of Salt Lake City and 3 hours north of Las Vegas. So it really sucks to get there, unfortunately. But it's a really beautiful site. That steam that you see coming out of that big pipe, that's our wells being tested right now. Actually, we just finished that test. You can't really see it because they're only, call it 8 feet tall or so, but there are wellheads. And that steam is coming from one wellhead. That one wellhead that you can't see produces around 10 megawatts of power. Those wind turbines in the background are each about 1.5 megawatts. And so just from a power density perspective, I always think that's interesting to look at. That's those fans and things that you see in the middle are the air-cooled condensers on the first turbine. And that'll be the first one to come online in June of 2026. So as it pertains to how do you access project finance in the future, this is a big part of it. Part of our strategy has been, look, there are lots of things that we're going to try to convince people of to improve access to capital. Let's take one thing off the table, which is resource risk. We know that project finance is either going to be late or unavailable for the first project. Let's just accept it. And we'll go after a really heavy equitized approach. And have actually had some early success accessing debt. We have a little bit there. But for the second project, it's actually going to go just to the right of that first one. So this is 100 megawatts coming online in June 2026. Just to the right of it, just to the north, we're going to build another 400 megawatts. And that comes online in June of 2028. And so part of our strategy has been, look, if project finance is saying you have everything that you need, we have the offtake with creditworthy counterparties. Southern California Edison and Shell are in this first project. Southern California Edison will also be in the next one. So let's check that box. We have access to transmission. This field is permitted for 2 gigawatts of production. So permits aren't a challenge. We've demonstrated supply chain. And so we're backing into all these things. And so what we couldn't prove on the first one is technology, long-term production, and resource, kind of all bundled into technology risk. If we take that off the table, there's nothing really left for project finance to complain about. And that's the moment that James mentioned where it's call me on the next one. The next one's coming, and it's right next door. And that feels a lot better than the one that's kind of in the middle of nowhere.
Second row from the back. Yep. Oh, yes, you. Yeah.
I'm just curious to understand, in the case of Fervo, as you mentioned, that you are transitioning from a traditional model in a way that you are fracturing the rock yourself. And then I'm curious to understand as to what are the cost implications for that, and how does the trade-off between cost and greater production level or greater certainty, as you mentioned that the dry hole rate was less than 30% with respect to traditional. Is that exactly zero? Is that less than 30%? How much less is that? And then what are the cost implications?
There we go. I got my mic to work. So I think the questions are kind of about fracturing and what it means for cost and various trade-offs. And I think there's a really interesting story in here about how entrepreneurs see the world. When Tim had this idea for Fervo, the first people he talked to were geothermal companies, and he tried to answer the question, why isn't anyone doing this? Actually, he quit his job saying, I'm going to go to the company that is doing fracturing and geothermal, found out there were none, went to get his MBA, founded the company. That's where it all began. I think, the way that conventional geothermal approached this question about cost and trade-offs and dry hole risk is not asking how do you create the well with the highest net present value. They said, if we're going to have dry holes, we have to drill the cheapest wells possible. So they used outdated technologies and off-the-shelf technologies, nothing bespoke. I had a conventional geothermal person tell me one time their best wells were their most expensive wells, because when you hit this void space where there's immense amounts of flow naturally occurring, you lose circulation and you have very few remedies to get it out. And the worse the lost circulation is, the more expensive the well is. And that was all the better for geothermal. And I just thought, man, that is absolutely crazy. Your goal should be to drive down costs and approach this from a manufacturing mindset. And that's what Fervo has done. And so our wells are more expensive than a conventional geothermal well that is successful. But one, our dry hole rate is zero. There are no wells that we're going to drill that have zero production. There might be some that have less production or more production. We approach it from a portfolio. So for 100 megawatts, there are 24 wells in this field. So it's a portfolio approach. We're going to have some that are really awesome and some that maybe aren't so great. And we have a range of outcomes in there for that exact reason. You want the average production overall. And we don't ask the question, how do we drill the cheapest wells? We ask the question, how do we drill the wells with the highest net present value? And I think that question alone is really at the heart of why conventional geothermal never got to EGS. Is because they always approached it from cost. But the rig that we had out drilling this thing, that sucker cost $30,000 a day just for the rig alone. You add on top people and fixed costs in the well, you're talking about $200,000 every single day. But we're drilling one well with 15,000 feet of depth in 17 days versus a well that conventional geothermal might drill, which is about 4,000, 5,000 feet. Maybe it takes them 60 to 90 days. And so it's are those types of levers that we look at. But the more that we can control the production and the more that we can manage expectations and design these wells for the long term, the less we really care about the cost so long as the returns are there.
Thank you.
Yes.
Sounds like Fervo and Breakthrough Catalyst have an incredibly successful partnership, but what should early stage startups and early stage investors be concerned about or consider when thinking about project finance? It sounds like you guys have things are working out, but doesn't always go that way.
So, I guess what to be concerned about. I think when we talk about project finance, right, there's a pretty wide spectrum of what that means. There's the commercial bank debt, right, which is, it's going to be your lowest cost capital. It's going to provide for most projects 80% of your CapEx needs to fund it. The downside is it definitely operationally restricts you, right? When you're providing senior debt to a project like that, you're going to have a bunch of covenants. You're going to have to go back to your lenders. And so, two things that I've definitely warned companies off of for their, what I'll call their like early stage projects is, you don't necessarily want to have debt for these. You want to really use this more as a R&D opportunity, a learning center, a center of excellence. And if you have all these constraints and almost a bit of a misaligned party in that they're really there just for their principal return and their coupon, you're not gonna be as nimble as you need to be as a startup for doing that. And so I think that's on the kind of the project finance side, that's a constraint. Even when you start thinking about project equity at the SPV level, so like a infrastructure fund coming into your project, for the most part, the companies that are doing that, they want control, right? They're not doing, especially on new technologies, nobody's doing a 30% minority investment. You're getting the big asset managers, and they want to take a controlling position, not only in your project, but usually some sort of controlling position or governance with your corporate level too, right? So that they have these alignment of interests. That too is, you're not necessarily thinking about things the same way, where they're going to be prioritizing return of capital on that project, while you may be thinking about how can I optimize this for project number 2 and our pipeline and our future growth. And so that is, for all the good that project finance does over the long term in scaling businesses, once you've kind of gotten to that milestone, there's so much focus on how to do it early on where it's not always great in all the instances. It does have its drawbacks or constraints if you're trying to be nimble, if you're trying to be flexible.
Did you have any perspective on how to think about it for other startups?
I think you nailed it. I think that's exactly right. Project finance is. I mean, I almost want to call it like a necessary evil in some ways. and entrepreneurs and founders don't like it, for all the reasons that James has described. But when you're trying to add $4 to $5 billion of projects to the grid in 5 to 10 years, it's really, really hard to raise that much equity. But in terms of limiting flexibility on the commercial pilot, we didn't even think about project finance there because we wanted it to be exactly that, a test bed. We want to turn it off, we want to turn it on. It generates a little bit of revenue, but it's so de minimis that no one really monitors, no one cares. But I think that's exactly right.
Thank you.
I have a question.
Oh, yep, and back.
So it's twofold. One is, have you looked at, or do you have a perspective on building on federal land? That's something that's come out in this administration. And a corollary to that is, I think the Department of Energy put out an RFI asking for respondents to comment on data centers being developed on land that is affiliated with the national labs. So obviously, Idaho National Lab, I don't know if NREL, would be a good candidate, but just any kind of thoughts on that, and have you had a chance to look at that RFI?
Yeah, permitting can be difficult, and federal lands can be difficult. And unfortunately, a lot of how difficult it is can come down to the BLM field office that has jurisdiction of the land that you've leased. I will note that much of this project is on federal land. And so our approach to this has been to be really, really proactive. And not every developer takes that position. You'll find some that don't want to engage with the local community. They kind of want to sneak by because of the public comment periods, and you try to limit as much exposure as you can. We did the opposite. We said everyone should know about Fervo before we ever do anything there. They should know who we are. They should have our hat. They're going to see our sign at the rodeo. They're going to see us at their high school football games. And that has been very, very successful. And that carries through to the BLM field office. It's not without exception. There are field offices that are good and bad. But what we have tried to do is bring them along for the journey with us and explain, this is what we're doing, this is what it means, here's all of our data. We publish all of our data for the most part, and try to bring them along. And that's actually why we were able to get that 2 gigawatt permit from the Department of Interior that covers the vast majority of this field. So it is a challenge. It's not, we haven't found it to be impossible. I think what we would like is to have some expectation management that, branches across different field offices. So if we go to somewhere where the field office is maybe a little bit less user-friendly, we at least know that there's a 30-day period and not, 180, 365, 6-year period for them to review. I think that's one thing. On the specific RFI that you mentioned on data centers at national labs, I haven't dug into that, but co-location is something that we're very interested in. It's maybe a little bit harder to do than it seems, just for redundancy and different things, but it's not impossible. It's just a challenge.
We have time for one more question in the front.
So this is a little bit tangential, but it's definitely about geothermal. It's potentially a great energy source. Obviously, water, if you can get it. Connecticut is a good place for it. So we have a 600-foot well already dug. And I went to a geothermal company and said, gee, couldn't you just take some of the water and run it through your whatever transformation, I'll call it, kind of a reverse heat pump. And they said, no, we have to dig a new one. And it's going to cost, I don't know, many thousands of dollars to dig a 600-foot well. Why can't you just use the water? We don't. Is there any reason scientifically, technically, why, a lot of Connecticut residents, especially up in the north, still have wells? Any reason why we couldn't do geothermal in, just as part of the well?
The short answer is no. There's no technical reason. It's an economic question.
I know. I gathered that.
And I'm not as familiar with heating and cooling geothermal as I am power production. We're very much on the power side and not on the other. But there is a corollary to shale oil and gas wells. So we get the question a lot. We've got hundreds of thousands of oil and gas wells in the country. Why don't we just use those? There are lots of kind of technical reasons why we don't understand how. The integrity of the casing. We don't understand what kind of formation there is. We don't want to deal with the co-production of hydrocarbons. Do you risk your kind of moral license at that point? Those are all considerations. But the economic answer to this is there's just not enough flow rate. And the two inputs to our system are temperature and flow. We actually don't care about anything else. We use an organic Rankine cycle turbine. The more temperature we have, the better. The more flow we have, the better. And so when we look at existing wells, for example, you would think that an oil and gas well, it looks about the same. It's about a 4.5-inch diameter. This project, that well, is a 7-inch diameter well, and we're quickly going to 9-inch diameter wells. And so
we're just talking about moving water up. Since we already move it up, just recirculate it.
And if the economics justified the investment in the turbine, then it would be worth it. And that's the question: is can you get enough temperature and flow rate for it to be worth it there?
Yep.
So maybe it's a cost of capital question.
Yep. Thank you.
Well, with that, thank you so much, David and James. This has been a fascinating discussion, and thank you, audience, for listening and for your questions.